CommitToWealth.com, creating a legacy by committing to real estate wealth.
Commit to Wealth Nation, welcome to the Commit to Wealth podcast. This is your host, Juan Vargas, bringing you yet another awesome guest. So our guest here for today is Jason Pero. Jason got his start in real estate investing in 2001 after buying his first duplex with his wife. From there, he was able to grow his portfolio up to 300 units before he was able to leave his job in pharmaceutical and medical device sales in 2012. He currently owns over 900 units throughout the Erie, Pennsylvania market, and he is actually under contract on another 127 units. So, Jason, welcome to the show.
Thanks for having me, Juan. I'm glad to be here.
Hey, it's a pleasure to have you on. So, before we started recording here, Jason, we're discussing a little bit more about your background, and it's just crazy, how many units, and I mentioned them here in the intro, 900 units. A large majority of those are you've been able to acquire them with your wife over the years, and then a few of those you've also have been able to syndicate, and this is more on the latter part of your career thus far. But tell us a little bit more about your background, and tell us how your start in real estate investing started.
Sure. So I grew up in a small town outside of Erie called Northeast, little grape farming community. Dad was a grape farmer. Mom was a school teacher. So kind of grew up, went through high school, went through college. Didn't really know what I wanted to do with my life, but wanted to make money because I didn't. We weren't poor, but we weren't rich. So sort of after college, kind of fell into reading Rich Dad Poor Dad, The Millionaire Next Door, books like that. And, I had an internship in college at a financial planning firm. And one of the things I noticed, this is really the trigger for me to invest in real estate, but I was setting up appointments with customers for the financial planners at the firm. And I'm going through people's files, and I would see like a doctor and a lawyer, they'd make $500,000, $600,000, $700,000 a year, but they'd have a net worth of, only a few $100,000 a year. And then there was one client, they were like two school teachers. There was like a school teacher and a secretary or something. And they made like $80,000 a year combined, but their net worth was like $5 million. I said, "Oh my God, how is this possible?" And one of the financial planners said, "Well, they have a bunch of rental properties. That's where most of their wealth is, and blah blah blah." And I said, what are rental properties? How does that work? And then at the same time reading Rich Dad Poor Dad, and you start kind of putting the pieces together. Say, well, really, if I want to be a millionaire, and that's as simple as the goal was at the time, because not having money, that's what you want to achieve. I mean, the goals obviously over the last 20 years have gotten different, and find ways to give back and really have a purpose to this thing. But met my wife, we started dating and sold her on this dream of say, hey, we can stay in Erie, we can work our butts off, and we're going to save all this money and buy rental properties, and we'll retire early. And that was as simple as it was back then. So, we bought our first duplex. She was still finishing up school, and I was working in sales. So we just basically saved everything we could. First, a few $1,000s, bought a cheap 2-unit. And then, it was going well. And we saw that, hey, this duplex paid for one of my sets of student loans. So she's finishing up college, we're working and saving throughout. And then the next year, when we got married in 2002, we bought another duplex in a 4-unit, and that paid for some of our bills. And we kept just doing it that way. We would live on one person's salary. So, I was in pharmaceutical sales, moved into medical device sales. She had a job as a pharmaceutical sales rep, and we literally just lived on one person's salary and did it the old-fashioned way. Just dumped all of our savings into buying rental property. And so we'd come across small deals here and there, and we'd buy a 2-unit, a 4-unit, things like that. But then fast forward to 2005, we had 23 units. We were doing all the work ourselves. So, we're leasing the units. My wife and I are cleaning, painting. She would probably do most of the maintenance and painting, because she'll tell you I was terrible at it. I mean, I'm not very good at that kind of stuff. But in 2005, we met a gentleman that had, at the peak of his career, maybe 130 units, which subsequently we bought all of that. But in 2005, he said, "Hey, I have 56 doors that I'd like to sell, and I'll hold the paper. You just have to come up with 10% down." And that was a $1.1 million deal. So we had to come up with $110,000. which we borrowed against our 401k, cashed in some stock, cashed in savings, took lines of credit, did everything we could to execute that deal. But that was like that first jumping point to where we're like, okay, now we can hire employees. Now we can start to scale this. But we really didn't have the big vision back then. But that was kind of like that catalyst for jumping into bigger properties, because with that portfolio, there was a few 16 units, there was a couple 8 units, there was a few larger properties, and he became a really good mentor and friend to us over the years, and that really helped kind of not just be better operators, but better investors as well.
So was this your plan all along? Was, like at the very beginning, whenever after you buy your first one, was your plan all along to, hey man, one day I want to be able to get to this many units and we're going to do it this way? Was that your plan from the very beginning, or was it like, hey, we're making enough money, both my wife and I, and wanted to dump the money somewhere, and real estate just happened to be the opportunity? Like what was your mindset back then?
Well, I think the idea for me was that, I said I didn't want to have to like work in corporate America for the rest of my life, and said, well, hey, we could work for ourselves. We could travel the world. My wife and I shared that vision. So we were like, hey, how do we do that? And we just thought, hey, we'll just buy rental properties, and at some point we'll be able to leave our day jobs and retire early. At the time, I'm in my early 40s now, and I saw guys in their 40s and 50s, and they seemed miserable, and it was just my perception of the situation. But so, my gosh, I don't want to do this forever. And so I thought rental properties, hey, if I just keep buying property, by the time we're at this age, we would have property paid off. We could, we wouldn't have to work for anybody else. And so, and it didn't, I had a hard time just setting an end date to it, because the problem was we kept making more money. Our responsibilities grew. We had started having kids. We have two awesome children now. But things change, and then so it was hard to let go of that day job for a while. But really, that was the goal all along, was to be able to work for ourselves and be full-time real estate investors.
And things just kept getting better for you, right? I mean, it seemed like it, right? So you kept buying, and you're making some good income from your W-2 jobs, and you're buying some good opportunities. So it's like, if it's still working, then why stop it, right?
Right.
That's kind of the approach that you took during those years, those first early years, right?
Yeah. Yep. And really, we were making what I think is still really good money. I mean, we were, combined making a handful of hundreds of thousands a year, and being able to save and invest, and then we sacrificed a lot early on. We've kind of didn't buy the big house when we could. We waited to do that. We didn't buy the nice cars until we could. We had company cars, and we really didn't take a proper vacation until like 10 years into our marriage. And I mean, we took long weekends and things like that, but we never went away and totally unplugged for more than that. So we did have a lot of sacrifice. But as you're kind of like the story of the frog in the boiling water. I mean, we were, just working, and you didn't realize what kind of toll it was taking on our mental health or physical health, or even our relationship, because you're just go. And so you just keep running. And so at some point you just have to have a breaking point and say, all right, enough's enough. And that was a big adjustment, leaving the day job into doing this full time, because, no one really teaches you how it's not something you learn in school on how to run a business. No one teaches you like stuff like that. I mean, you can learn how to rate a balance sheet, but how do you hire and fire? How do you work on your goals? How do you manage the roller coaster ride and things like that? So it's definitely an adjustment those first few years after leaving the day job.
Yeah, no, I definitely agree with you on that. I mean, you get to learn a lot in school on specific subjects, but not necessarily how to properly run a business. And yes, there's business classes, but it's totally different when you're out there in the real world and you're actually taking action. And there's so many day-to-day activities that you got to focus on. So tell me a little bit more about the properties that you were buying. Were these, just cheap, old properties that you're buying, and picking up at a great price, or were these like nicer and better neighborhoods that you were just putting minimal money into? What was your strategy?
Yeah, so it was kind of a strategy of just buy everything we could. So it was a mix of a lot of everything. So we had, so for instance, the deal we did when I left my day job in 2012, was a deal from the same person we did our first large, owner finance properties with. And he had a very nice 26 unit and 16 unit located within the city of Erie and good locations. And then a 30 unit townhome complex in a suburb of Erie. And so those were very nice properties. And we had bought some other very nice buildings along the way. But then, we were capitalizing on the fallout of 2008. So we were buying, these like $10,000 dumps, single family home or duplex. So we put in, whatever it took to get those up to a quality rental. So we would take garbage and turn it into something nice. But we just kept buying everything again, whether it was a single family home or a duplex or a 20, 30 unit building. Really didn't have a super narrow focus at that time. It was just trying to grow the portfolio and build the cash flow.
So I noticed that you discussed, the seller carrying a note, right? And we even before we started recording, you discussed that a little bit as well. So is that something that you still are able to be able to negotiate today, like in this market, or was it just in the early days?
Yeah, no. Whenever it's possible, I we like to do that. I mean, I think that was the first exposure for us to that, where a seller would carry the financing. But it's worked both ways. We've done for others what some of our mentors have done for us, where we've said, hey, you may not have a ton of capital, but you'll be able to get into a deal for 5-10%, and we hold the paper. So we've done that on the back end for some some guys and gals that we're mentoring and kind of showing the ropes in the business. But just recently, end of January of this year, came across 23 units. Doesn't sound like a huge deal when we're syndicating and we have, deals in the multiples of hundreds of units coming online. But it fit our business model because there's a little college town outside of Erie called Edinburgh, and a lot of college rentals, but there's a lot of folks like looking for regular non-college rentals, it's people that work for the university, just other people that want to live a little bit outside of Erie proper. So, we have 100 and at the time had 120 units down there. This is another 23 units, really close to what else we own down there. And had these guys that were partners. They've owned these properties since 1986. Have been talking to them for a few years, and ultimately around Christmas time, we kind of reconnected, and we met up, I think it was the 23rd of December. And so, well, look, would you guys consider holding paper? And I asked them the same question a few years ago. But I think we phrased it in a different way. It was like, well, what would you do with the proceeds, after selling? I mean, what's the plan here? And it wasn't really as important to us to get the owner financing, because we knew, we've got very strong relationships with local and regional banks. The deal wasn't quite to the size that we would have used agency debt on it or anything like that. But we were able to just negotiate a fair deal for both sides and close quickly without having to deal with appraisals and all that extra stuff. So so we try to take advantage of that as much as possible, where you have a seller that, especially these days, if somebody's looking to sell, I mean, they have to wonder, are you going to put your money in the stock market? Unless they're very savvy and they can buy the right stocks they think are going to appreciate or play that game. But most people, I think, especially when they're at retirement age, probably a little fearful of that type of plan where overnight they could lose 30% of their net worth, as we've seen in the last couple of weeks. You
are correct on that. And when things are going well, they're going well, and it's working out. And unfortunately, the stock market is so much more volatile than real estate, in my opinion. At least with real estate, it's still a basic necessity. So yes, it does get affected. During some sort of situation like we're having today these days, it does get affected. It's not immune to it, but it's still a necessity at the end of the day. So it's still something that where people need to live. They need a roof over their heads, right? Yep. That's why I like it. I'm sure that's one of the reasons why you like it. So let's talk about the financing terms. And I know you kind of touched on it a little bit on discussing paper, carrying the notes. How are financing terms different then, and were you even using financing, or were you just paying cash for your properties? And for the ones that you did, if you did, how is it different then than it is now?
Yep. So you're asking when we started out, how it was?
Yeah. Like you started out, were you buying these properties cash, or are you financing these?
So
And
yeah,
go ahead.
yep. So most of what we did simply was, we would save up, 20 to 25% down. When it got closer to '08, it was 30% down, 25 to 30%. So we weren't really over leveraging, and they were all 15-year mortgages for the most part with local and regional banks. So built some really strong relationships with those, and just, again, because at the time we didn't really need all that cash flow. So it was a matter of, hey, we're building all this equity, really kind of front loading, paying down a lot of that debt. And when we did a few of these owner finance deals where they're holding mortgages for a little bit longer terms, 20, 25, or 30 years, we saw that cash flow kind of pop up. And really, just till a couple of years ago, I went and, renegotiated a lot of our deals with our local and regional banks, and either reset them at 15-year terms without drawing out. I didn't really look to draw out any equity or cash out, but just to really improve our monthly cash flow. So we did that kind of across the board over the last couple of years, where I just, I didn't have a crystal ball. I mean, we all know a correction was coming, but said, look, I really want that cash flow to protect us in the event of a downturn, and just to be able to operate at the best possible level just on a day-to-day situation. So, on those shorter loans, it's really hard to make money and take care of your property well. To do both well is a big challenge. So, it doesn't even have to be a 30-year term, but something in the range of 20 or 25 can really help that cash flow. And look, at the end of the day, if you don't have cash flow, where's your motivation to keep that investment? That investment moving forward in a positive way. So, we still utilize regional bank, local bank financing when it's appropriate. Almost treat that as a bridge loan in a sense. If we're buying property in a certain area, and then when we've got a cluster that's stabilized, we can take that over to some agency debt. So we've done that successfully a few times. And then again, for our larger deals, the stuff we're syndicating, or something that, again, would have a loan balance of $1 million or more, we're using Fannie and Freddie small balance loans, which have been fantastic, because really better interest rates, opportunity for interest only. If you're doing some sort of repositioning or just trying to stabilize something into your own operations, it really helps to get that added flexibility.
Got it. So that's very good to know. You're doing shorter term mortgages. Just to be able to upfront some of that equity upfront, because you weren't in need of the cash flow necessarily. And then recently, you were able to restructure your loans or your mortgages, and then do them again for 15 years, which it stretches out the cash flow per month. You're able to really get some better, definitely a lot better cash flow from that point. Very good. I like that. So your properties, are you self-managing? Do you have a self? Yeah, is that what it is? Yeah. You have a management company? Okay.
Yep. So we don't do any third-party management. Sort of stuck our toe in the water with that a few times over the years, but just realized that that's a thankless game, because you're going to have owners that are mad at you. You're going to have tenants that are mad at you, and really, your customer may never see eye to eye with how you think something should be managed. So, as an example, if you have to turn a vacant apartment, say it costs $2,000 or it costs $5,000, they're always going to question, as they should, the spend. But I found I don't need to justify our decisions on when you want to replace carpet or replace a countertop or do those types of things. So really realize that if we're the ones calling the shots in terms of managing our own portfolio, but managing what we're syndicating as well, I think we've got the track record and experience to, that people trust that we will do it the right way, we'll do it well. But I just had a hard time, early on, when again, my wife and I, we didn't know any better. We're building this portfolio slowly, and we're doing it all ourselves. That's all we knew. And then when we knew there was other property management companies out there, just never got the sense that, and I guess our first mentor in the business said this to us many times, and it just always stuck with me. They said, no one's ever going to care about your investment as much as the owner. So, in a challenging time like this, during this coronavirus epidemic, a lot of owners have to really be in sync and simpatico with their property management companies to make sure that everything's going well and going as well as it can. But when you're self-managing, you have the opportunity to really call the shots, and that, of course, probably adds another few layers of added pressure to make sure that things perform well. But at least you're in control, and you're not. Hopefully, can put some things in place to to make sure that you're not going to suffer too bad during a downturn.
Yes, no, I agree. I mean, I think there's a lot of property managers out there that really will take that more ownership approach, and they'll treat it as theirs. There's a lot of good property managers out there, but I would say at the end of the day, it is your property. They are your properties. It is your portfolio, and really, frankly, I think you're the one that's going to care about it the most. I mean, there's no other way to say it. I mean, that doesn't sound bad, right? I mean, that's just the truth, So that's very interesting. So what mistakes have you made in the property management side? And I'm sure there's one or two stories that you can tell us. Yeah. But what's one of the biggest mistakes that you made, and what did you learn from that?
I think one of the biggest mistakes as we were growing is just still trying to hold on and do a lot of this ourselves, or at least me specifically trying to do it myself, where in the past, just trying to take so much control, and what that resulted in was where my wife and I built the business together. I wasn't sharing some of the responsibilities and duties where she could have easily done things better and more efficiently than I could have. But as that's translated to now, where we've got all this this much larger portfolio, we've been able to really step back and both of us have good roles and responsibilities in how we operate the business, but hiring people that are frankly, probably better at us than a lot of things, and letting them run with it and sort of setting up the systems in place. And I think I just resisted that for so long. And that's probably the biggest mistake, was that, look, just step back and hire people that are better than you at things, and it'll really free you up for your highest and best use of your time.
That's right on. I mean, that's exactly what you want to do, right? Hire people that are better than you in specific areas. You don't have to be the smartest person in the room. I mean, you want those smart people on your team. So tell us a little bit more about the today's market. Specifically, you mentioned COVID-19. Yeah. That's what we're going through. I mean, it is very unfortunate, but it is reality. What are you doing today? Are you still looking for more properties? Are you kind of holding back and kind of waiting for the dust to settle a little bit? What is your strategy right now?
Yeah, so we're a little bit of both. Yeah, so we have 127 unit under contract that we got under contract about a month ago. Interestingly, we didn't have really any challenge raising the money, and we didn't have to try to raise the money. We'll have the agency debt in place. That's not a big deal. The challenge we're facing is getting the third party inspections on time, because if we're under, say, a life sustaining businesses only, how do you get a property inspector to come into town and walk through tenants' units? That's just not realistic or feasible. So that'll put some delays to the process, but I've spoken with the sellers, and we already had some extensions built into the contract unrelated to the COVID-19, just saying, hey, if something weird happens, and of course something weird happens, so we've got that extra buffer in there. So we're still proceeding, and we try to buy deals. Again, living in a tertiary market, I think we're insulated a lot from, it's not like one employer taking such a major hit, and the thing is with unemployment, this federal stimulus package that I know the interview will get released after the fact, but looks like it'll be passed today. And there's some societal guardrails in place that the vast majority of our renters should be able to take advantage of. The only, maybe negatives if people just say, well, forget it, I'm not going to pay my rent, and I'll just wait and, wait this thing out. But I don't necessarily see that happening. We've already reached out to the majority of our tenants. We've heard from a lot of people, and what I've seen is either people paying ahead on their rent. So we're getting an April rent. So we've already had a few that paid April and May, just to be ahead of the curve a little bit. Yeah. And so, but we've taken a very, I guess our approach isn't so much of a reminder that, hey, your bill is due. I think we all know that, as owners, operators, we know we have mortgages. I think our tenants understand, they have obligations too. I think our approach has more been from a customer service standpoint, to have our property managers and site managers reach out to every tenant and say, hey, we're checking in. How are you doing? What's going on? Do you need assistance? Like, let us know what's happening in your world. And so, people will reach out, hey, I lost my job, but I'll be getting unemployment, so I may have to pay the rent, over a period of a few, like a couple weeks. And so, I'm kind of bullishly optimistic that revenue won't really be too much disrupted. I think there will be some disruption, but in the short term, I think that'll be okay. We'll definitely have some workflow adjustments because, the way it looks right now with the restrictions for work that are in place, our team can really only respond to like true maintenance emergencies. You don't want guys out there just tinkering around with like preventative maintenance stuff in buildings when we're supposed to be social distancing and really isolating ourselves. So they're really just working on emergency things only. Some of our property management staff is working from home, fielding phone calls and things like that. So there's a little bit of adjustment in the operational side of things, but I guess I apologize. I'm a little all over the place here, but switching gears back to the syndication part, I think from an investor standpoint, we reached out to all of our current investors first and dropped a courtesy email. This was a week and a half ago on Friday the 13th, 9:30 a.m. Just said, hey, we have another deal coming your way. We'll send out the offering memorandum Tuesday, but just hit us up if you want to reserve a spot. And we already had half of the money committed by noon. So like 2 hours later, and then over the course of the weekend, we had overfunded the deal. Now, since then, we've had people that have kind of said, hey, I want to pull back and sit on the sidelines, but we're still overfunded in soft commitments for that deal. And I think that, for the most part, folks might be a little bit nervous, but we're trying to lead them with a steady hand through this time and say, hey, look, like this is why we, when we raise money, we have 6 months of reserves sitting there, because as a syndicator, if you're that thin right now that you're already, we should all be worried about what happens if our tenants don't pay, but April's not even here yet. So I'm not quite concerned about, well, what happens if I can't pay my April mortgage? I think that, in the event that, hey, we're syndicating, our investors expect quarterly distributions. I don't know that, if you plan it properly, it shouldn't be too razor thin as to where you're not going to be able to meet your obligations for a few months and be able to work through things with your investors. That I think there's maybe a little bit of, it doesn't hurt to be prepared. And I think you should reach out to every lender, but I think it might be a little premature in terms of thinking the worst, if you're a syndicator or a sponsor of a deal.
Yeah. And it's crazy to think about, everything you just said, right? But this is reality. Going back to the very beginning of what you said, inspections, right? Going back to that, I think it's very important. And, listen here, everybody, hopefully you can take this as a note. I think it's very, very important for you to, if you're looking to buy properties, and I'm not saying that you should or you shouldn't, if you're looking to buy any properties these days, that you got to make sure that you have contingencies in place. For example, due diligence. You may not be able to do proper due diligence because you may not be able to go into the units because the tenants are not going to want a whole staff to go into their units, right? So you're not going to be able to do part of your due diligence. You may not have some of your trades, your third-party vendors, those kind of guys go out there. They're simply, they may not be available, right? So it may prolong your due diligence, and it'll still leave some question marks. So you got to make sure that you have that. In addition, on the other side of that, you also have the debt side, right? And I've heard numerous different things. I know I'm kind of getting off topic of what you kind of mentioned, but I just wanted to add this here real quick. I've seen numerous different things going on on the debt side. Capital markets it changes hour by hour, it seems like, to where one of the latest ones was Fannie. And this just came out yesterday, right? So maybe by the time this recording comes out, it's already out there published, but it just came out yesterday where Fannie, on deals over $6 million, they were requiring 12 months of debt service, 12 months of taxes and insurance, and 12 months of replacement reserves. Mm-hmm. So this is on deals over $6 million, and then on deals under $6 million is 18 months for all the above. So what they're trying to do is they're trying to cover themselves. Of course, this is Fannie Mae. This is multifamily rate. Fannie Mae Freddie Mac may come back and do the same as well.
Yeah.
But these are just little things that you have to know if you're a buyer, but also if you are an investor looking to invest some deals, it's very important that you also ask your operator, your sponsor, and say, hey, how many months of reserves do we have right now? Because things can change. You may have today, and then a month from now it'll change. They can just slip that into the situation, into the deal, and you got to come up with the money somehow. So just a FYI, I don't want to scare anybody. I just want everybody to be aware, no matter what position you're in. And if you're not planning on doing anything now, it's okay. But at least you'll know more about this, right? So just something the FYI, keep your mind on that as well. So Jason, what is next for you?
Yeah. Well, I tell you, I think one of the big things we like to continue to, to keep kind of growing our portfolio the way we have. So really have enjoyed, the syndication journey the last couple of years, and it's been really rewarding in terms of, how we're able to, grow into better and larger properties, but also serve more people. So it really is gratifying when you have a group of passive investors that enjoy and appreciate the stability and the predictability that our real estate investments offer. So I really get a charge out of that and enjoy that. So so we're going to continue with buying up everything we can in Erie, but we're getting close to running out of available property here.
Have them all. That's why.
So we have a couple of markets that we're looking to expanding into outside of Erie, but at the same time, I like to dispose of some of the lower hanging fruit in my portfolio. So as we keep laddering up, it's not necessarily about the doors. It's about cash flow but again, if we've had a property for 15 years, maybe now's the time to sell it off and let somebody else take it over. So we've been doing a little bit of that. I do spend some time, I have some real estate coaching students, which I really get a kick out of, because, you're seeing people along in their journey. So we have a ton of fun with that, and just continuing to try and make the best out of every day. We have a lot of fun with just building our business, and I hesitate to put a number of doors on there, because I think early on that was the goal I had was, let's just get this many doors, or let's, and just grow for the sake of growth's sake. But to me, it's about cash flow. It's about, giving back to others and treating people well, and really trying to see, our employees grow. So sometimes the growth right now might just be the fact that if we're able to help our employees grow, mentally, financially, professionally, then that helps us grow. And that's just a nice byproduct of it. But, I don't want to do that at the expense of enjoying time with our family and friends. So if we just work and can't travel and can't do the things you want to do, then what's the point, right?
Exactly. No, I like that. I really like your strategy as well. I mean, I think it's a patient strategy. I think maybe at the beginning you're ready to buy deals, left and right. But you also realize that it's a long-term game. It's not just buying a deal and then getting rid of it. It's a long-term gain or game. And you can really build some really strong cash flow and wealth, for your family, right? For many years to come. So it is time for our next wealth. These are questions that I ask every guest every week, and hopefully they are able to help out the audience. So Jason, question number one is, what is a good tool, source, or platform that you use almost daily that can also help others?
So two things. I use, honestly, it's as simple as, but Facebook, I love some of the Facebook specific groups that, that are targeted to our business. So, a lot of us go to conferences and we see each other a few times a year, but it's really great to stay connected, and, you can see how people, especially in times of crisis and where it's easy to panic, it's easy to talk to your friends locally, and you talk to your spouse and your friends and things like that, but to connect with somebody on the other side of the country and see how they're handling their situation, that gives you new perspective, but also maybe give you some comfort to know that everybody else is facing the same issues, and maybe help you shortcut your challenges a little quicker. So I love that. I'm not much on it. I like to check in and see what my friends are doing, from high school, but I think, these days for business, it's great. And then from the property management side, we use Propertyware as our platform, but you have every report, it's at your fingertips on the dashboard of whatever software you or your third-party manager would use. So I think that's just crucial to checking in on the health of your investments on a daily basis.
Got it. Okay, great. Yeah, those Facebook groups, I agree with you. I mean, they're awesome. You're able to just connect with your peers, your colleagues, like all the time. Just simply, right? And you're able to stay up to date. I mean, guys, it seems like, guys are always trying to be the first to post like the latest of what's going on, which is good, right? Because you're able to see, hey, it's kind of like live, like in other words, right? So you're able to see some really good information out there and reports. What was the best business advice you ever received?
Best business advice I ever received, I think was, and this was something I got from my my day job about 13 or 14 years ago, but got pointed in the direction of personal development. So the manager I had at the time said, work harder on yourself than you do at your job. And that was a quote by Jim Rohn, and probably used by every personal development guru out there. But that was the best advice, because at that point, when I started setting goals and journaling and really trying to work on my skills and my mindset, that's when it all changed for me and things got better. And that's how I think really be able to navigate these crises in a positive way.
Good. How do you best manage your time? I mean, you have a big portfolio there. I mean, you're getting into syndications now as well, property management of employees. And what do you do? How do you best manage your time?
Yeah. So I've tried everything under the sun, but what I do is I still set my goals every week. The things that are crucial to whatever I'm working on, and usually I just leave it at 3 super important things. But I honestly, I make time for myself every day, and that sounds selfish, but honestly, like if I can spend an hour and a half or 2 hours at the gym, it's not just about escaping others or taking that time for myself, but it's about getting in that, priming my mind and my body for being able to be at my best and be at my peak. So if I'm on the treadmill for 40 minutes, outside of a COVID-19 lockdown, I mean, I can clear my mind. I can think about the things at hand. And when I'm back in the mix with our employees or working on the business, I just, very efficient and ready to go. So that's the number one thing I do, and is just making time for myself every single day, and making time for my family, because if I have that balance and those things are in line, everything else follows. I know that's like, a lot different than time blocking and miracle morning and all that stuff. But honestly, I think you just have to find what works for you, and that's what works for me.
Got it. So there's not a specific type of situation or strategy or routine that you do. Just you find a way, like every day, to make that time for yourself, and you go all in during that little time block, so to speak. But it's not like a certain strategy that you follow. Like at this time, I'm gonna be out. You just kind of make the time, right?
Yeah. Well, and I tried, and that's the thing. I've tried, Miracle Morning, and I've tried all these other strategies. But what I found is that, those work great for some people, and others, you have to learn to adapt to what works for you. And so I found that, it's not just about taking time for me, that I'm just sitting around, twiddling my thumbs. It's about taking that time, but I'm also meditating and marinating on my business and thinking through the strategies for the day, week, and months ahead, that type of thing.
Makes sense. Got it. I like that. How do you, or rather, which book has really impacted you the most? And you can say this on your business, or you can say this on a personal side.
Yep.
And then a second question is, which book are you currently reading today?
Okay. So the book that's probably impacted me the most was The Compound Effect by Darren Hardy. So, that the premise of the book is that, it's not about these like massive action and massive changes that make all the difference in your life. And those things are important, but it's about those small incremental daily changes that, like if you eat a Twinkie for breakfast every day, you're not going to be 50 pounds overweight overnight, but at the end of the year you might be. And but if you eat an apple every day with your breakfast, it's like, you're not going to lose 50 pounds overnight, but it's that those small little choices that make all the difference at the end of the day. And so I really think that's been been one of the biggest game changers for me. And I've read that book and gifted it so many times. And right now I'm rereading Old Charlie's Almanac, which is an amazing book. Probably the second tie, probably a tie with The Compound Effect, but it's a compilation of speeches and writings by Charlie Munger. And a lot of your listeners have probably heard of Charlie Munger. If they haven't, he's basically Warren Buffett's right-hand man. And it's an amazing book. I mean, it doesn't really have a lot to do with real estate, but neither does Rich Dad Poor Dad, right? It's all about mindset. And how does Charlie Munger and how do Warren Buffett think about business and life and all these things? And it's just super fascinating. And I think I have a whole journal of just notes that I take from that book and like, oh my gosh, this makes a ton of sense. And really was kind of a neat guidepost to me when I first came into it. And I've taken so many nuggets of wisdom out of that over the years that I just, I need to order another copy because mine's like, it's this huge book, but it's like, the pages are frayed and everything's just, but that's an amazing, amazing book. So anybody get your hands on that one immediately if you can.
That's a good one. I'm going to try to pick that one up as well. So yeah, I like that. The Compound Effect, that's another good one. Another book that's very similar to that is The Slighted Edge. Yep. I don't know if you read that one, but it's pretty similar to The Compound Effect. Yep. And they're both very good books. So yeah, I definitely recommend them for sure. Last but not least, at the end of your life, how do you want to be remembered?
I want to be remembered for somebody that, as somebody that, loved his family, gave them his all, gave his all to his family, his friends, his business, and didn't leave anything on the court. They say in sports, leave it all on the court or leave it all on the field. So I just gave it his all and was, remembered as somebody that was kind to everybody, no matter the circumstances, and gave back to others that needed it. Love it.
Great answer. Where can Commit to Wealth Nation go to contact you and find out more about you and your business and just to reach out to you?
Sure. People can go to my website, perrorealestate.com. If anybody wants to connect, hit me up on LinkedIn or Facebook. And then if anybody wants to schedule, a 15 or 20 minute just strategy call, I have nothing to sell, but just to talk real estate, talk business, especially in these times where we're all kind of quarantined. Just easy to reach out. We can hop on a phone call or a Zoom call and just stay connected through these tough times.
Yeah, no, that's great. So, Jason, man, I really do appreciate it. Man, I love your story. Your story is awesome. You've been in this the business for a while. And I really did enjoy our conversation. Everywhere from your start to growing your portfolio to managing your deals through some of your crazier stories as well. And to today, right? You're going to be growing even more on the syndication side. So, again, I really do appreciate it. I thank you so much. And I wish you continued success.
Yeah. Thank you very much, Juan.
CommitToWealth.com, creating a legacy by committing to real estate wealth.